Good morning, everyone. Thanks for joining us for our quarterly feedback. It's a wet and cold morning in Cape Town, and I have on good authority it's quite chilly in some other parts of the country as well, although apparently in Joburg it's heating up at least a little bit. We're going to be talking about a couple of things today, but I just want to thank you for your attendance. And please ask questions throughout the session. We do have a question event, and I'll either pause to stop them there, or we'll do them a little bit later on. So let's get going. So the topic for today is where to next, qua borders, where to from here. So let's quickly start. Very famous old quote, those who do not learn from history. If we look at the rates, or at least at the screen there, what's up there is the South Africa's CPI year on year, the inflation rate in South Africa effectively since the end of 2005. Now, what we can see there specifically is the peak in 2008, and how for a pretty decent portion of the last 10 years, inflation has not always been as contained as we want, but mostly contained. And some of the dips we've seen in inflation now recently has been some of the lowest rates that we've seen in the South African market, at least for the last decade and a half. If we move and we look at just our repo rate, we can see a similar kind of pattern play out there. This goes back to 1998. For those of you that remember then, Chris Stals was at the SARB, and what we saw during that time was the repo rate peaking at 20%, actually a little bit above 20%. Bonds were trading above 20%, and some of your happiest clients, I'm sure, have guaranteed annuities that you did at that time. And since then, it's quite interesting to see that every peak in the repo rate has been lower than the previous peak, and every trough in the repo rate has been lower than the previous trough. Now, you can talk to a range of people as to why this occurred, what the various things were that impacted this, but broadly it's a combination of factors, right? It's a combination of inflation expectations in South Africa becoming more and more anchored to the 3 to 6% kind of bands. It's an indication that there's more trust in the SARB and the SARB's policy expertise. To some extent, it's South Africa's economy and policy actions maturing. But there's also the impact of global inflation and global rates on this, because we can't overestimate the degree that global inflation has played a role here. And then there's one other thing which is important, which is that the impact of things like, for example, the currency, the rand, has played a less of a role over this period. About 10, 15 years ago, what was called currency pass-through was about 20% in the inflation basket. In other words, if you think about the rand depreciating by 10%, then about 2% will be added to the inflation rate, and vice versa. As time has gone on, that has dropped quite significantly. It is now meaningfully below 10%, which means that to a large degree, our local inflation rate is affected significantly less by the moves in the rand than would have been the case 10 and 15 years ago. But this is not the whole picture, and I think it's important that we just kind of look at the global picture, because I think I've often spoken to many of you before and said that South Africans tend to hyper-focus on our own country, on our own problems and our own situation, and they tend to underestimate the effect that the globe has on them. And what we have on the screen now is the US 10-year rate. And we can see there when Paul Volcker was ahead of the Fed in the US, the US 10-year rate was pretty close to 14 to 16%, right? It peaked in the 1980s. And since then, we've seen a consistent decline in the US 10-year rate from there up until now. That dropped along with front-end rates, it dropped along with US inflation and US inflation expectations. And you can imagine that this also affected South Africa. Now, it's important also to realize that this is not a purely US situation. Is there something blocking my part of the screen? I apologize. I'll get that out now. Just give me a sec. There we go. Sorry. So if we, let me go up a little bit. We see, so there we go. That's the US 10-year rate going, by the way, thanks, Chris. There's a US 10-year rate dropped all the way now, and you can see that it actually bottomed out in the start of last year in March. It bottomed out at below 0.5%. And currently it's trading about 1.24. There were fears earlier this year towards the end of last year that US rates are going to go up. They did quite a bit from 0.5 to about 1.7. They effectively tripled in over a 12-month period, or less than a 12-month period. But since then, they've started to drop down again. They're now sitting at 1.24. Now, as I said, this is not a US-only trend. Right, on the screen, you've got the 10-year rates of both Japan and Germany and the US, all the way from the 1990s to now, over an over 30-year period. And we can see a similar kind of metric playing out on in those countries. Now, a couple of notes there. You can see that the Japanese 10-year rate is at 0.016. It's effectively nothing. You can see the German 10-year rate at negative 0.45. So negative 0.5% for a decade per year. And you can see the US rate still positive, but inflation expectations in the US are a lot higher than inflation expectations in those countries. So the real rates in the US are now either at or all-time lows as well. The TIPS yield, in other words, the US Treasury inflation protected securities, their version of the inflation-linked bonds, that dropped down to an all-time low a couple of weeks ago. It dropped to below negative 1%. So we can see that this dropping rates situation that we find ourselves in is both not just a recent trend, as I think a lot of people tend to think. They tend to view the drop in rates in side to side with the quantitative easing programs and those kind of things that we've seen since 2009, 2010. But in truth, if you look back, you can see that the US rates, Japanese rates, German rates have all been on a secular drop, effectively from the 1980s up until now. Now, this is a very interesting chart that I tracked down on Twitter. Unfortunately, I don't know where it's from. But if you look at the long-term rates of inflation, right? The long-term rates of real rates over time, and you track it down back. In this chart, they track it back effectively to the mid-1300s. The one thing that you see is that real rates have consistently dropped over effectively a couple of 100-year periods. You can see there just after the Great Depression, it dropped. That coincided with the Second World War. You can see real rates dropping significantly as well during the First World War. But effectively, you can see that real rates and what people pay for debt relative to inflation has been dropping quite consistently now, not just for 10 years or 50 years or 100 years, but quite consistently for a couple of hundred of years. Yes, there's certainly been spikes, right? And some of these spikes and cycles last not just a year or two or a decade or two, but you can see the period there from 1973 to effectively, 1793 to 1821, a 30-year period wherein rates rose from almost zero back to almost 12% in real terms. Right? So there are cycles, there are roundabouts, and there are turns. And some of these turns might be a single person's entire investment career, but consistently, almost in much of the last couple hundred years, real rates have been dropping. So the question is, what's going on at the moment? Right? We've seen, and we can see this on the screen, that inflation is rising. That's the gray line, and the red line is US ISM prices. So you can see inflation jumping up. And the question is, It's now the highest that it's been effectively since 2008 and 2009. And for the first time really since monetary, let's call it modern monetary theory, have been a factor in economics, we're seeing something that might look like the start of an inflation cycle. For those of you that don't remember or that weren't necessarily involved in the markets in 2009 and 2010, the fear of inflation, the specter of inflation, was something that dominated global markets for 2010, 11, and a long period since then. And the reason for that was the printing of money, right? That's what it used to be called. When Zimbabwe, Venezuela, or Argentina, or those places print money, right, to pay their own debts, to manipulate their markets, they call it printing money, monetizing debt. When the US and the ECB and the Bank of England does it, it's called quantitative easing, right? So it's a bit of a different term, but it's effectively the same thing. Now, of course, there's differences in application and degree and effects and reasons, but the primary fear that the significant, let's call it monetary stimulus, monetary injection into the markets would lead to realized inflation on the ground has been something that economists and market participants have either been fearing or discussing since the early 2010s. However, that has not realized. At no point effectively since then has inflation really been a significant factor or a scare over the last decade. We saw some inflation spikes in 2011, but long-term inflation has generally been contained and interest rates have been dropping consistently. Now, we can discuss why that's the case. One of the more interesting theories is that inflation has not so much been contained as it's been primarily experienced in the asset markets. In other words, we saw asset market or asset price inflation primarily in things like stocks, shares, and bonds, and that's been true. So the question is now that inflation is high, and you can see some other issues coming and jumping around, is inflation around for good? Are we going to see one of these pickups in inflation? Or is it the current word that is being used is transitory? Is inflation truly transitory in the international and global markets? And for now, the specific focus is going to be on the US. So let's just discuss what is and what will be driving inflation and what has been driving inflation, at least in theory, for the last decade or so and for the next decade. So things that drive inflation up, that push it upwards, are things like money supply, right? How much money is there in the markets? One of your basic theories in economics is that the level of prices in the economy is the amount of money available in the economy multiplied by the rate at which money circulates in the economy. Right? It's money quantity multiplied by money velocity, right? And that equals price. And GDP, but we can ignore the broader theories of economics for now. Effectively saying that money supply is one of the primary things that people think influence the level of inflation. Now that's been going up and is likely to continue to go up. Supply constraints, right? That's been a factor primarily for the last year, and we've seen it play out in a couple of places. We've got fiscal stimulus, right? Suddenly, specifically in the US, but also in South Africa and many other countries around the world, we've seen money going directly from the government to the people on the ground. And that has had some interesting effects. And then another interesting thing is that there's been a little bit of a change or disconnect in how the job market has been working in places like the US. And I'll go into that as well. Now, what are the things that push inflation down? One is demographic factors. One is technological change. One is developments in society, right? And we can look at a couple of ones. For example, one of the big developments in society was the significant increase of women in the workplace over the last 100 years. right? If you think about that, it effectively doubles your available work and talent pool. And that has significantly led to the effect that there's more labor, and hence the cost of labor might be a little bit cheaper relative to the cost of capital. And then lastly, you had some growth restraint. Sorry. So let's quickly just look firstly at some of the things driving the prices up around the world. The first one, as I said, is the injection of money. And what we can see there is that effectively, we've seen the Fed balance sheet expand significantly in 2020. Right, it jumped from just over 4 trillion US dollars to just under $8 trillion. Then we saw a little bit of an unwind towards the third quarter last year, but since then we've seen it continually grow over time. So, and that you can find in Japan, ECB, and as well as the Bank of England. An effective expansion in the balance sheets of some of your largest countries in the world. What do they do with those balance sheets? Well, they buy government debt. Well, that was the original plan. Then they started buying corporate debt, but just investment grade. And then they started buying corporate debt, but you know what, also high yield. And then they started buying mortgage-backed securities. And in Japan, they started buying equity ETFs. So government's directly participating in the markets. And there's a little bit of an old economic saying that once again has more to do with monetary circulation than it does Fed policy, but it's that bad money drives out good money. Or in this way, the application would be that Fed participation in markets drive out markets or investors' participations in markets. And when they drive them out from, let's say, European sovereign debt, they drive them into European investment grade debt and European high yield debt. And that has knock-on effects across the globe, because those market participants then drive out others, and so on down the chain. The other question is, why is so many things suddenly so expensive? Right? What has been happening? Now let's look just quickly at two things. Up on the screen, you've got two charts, right? There's a white line and there's a blue line. Now the white line is what's called the CRB Raw Index, right? Commodity Research Bureau Raw Commodities Index. And what you can see is over the last, effectively since the 1st of July last year, is that this is up 44% on an annualized basis, right? So think about that. That's the price of copper, the price of coal, well, not so much coal, the price of copper, the price of iron ore, right? Those kind of things are up significantly, 44% over the last 12 months. So some of that is supply constraints, some of it's a little bit of demand, some of it's just the fact that you struggle to ship it, right? The other line is a blue line. It's the Baltic Dry Index, and it shows the price and the cost of shipping and how that's changed over the last year. So you can see that the cost of shipping is up effectively 75%. So your raw commodities are more expensive, and your cost of transport, both the raw commodities and the finished products, are more expensive. So you have these two factors that suddenly put an upward pressure on prices to a not unprecedented, but a somewhat rarely experienced degree. So you can see that these kind of price pressures from the supply side is pushing up prices, right? Okay, let's see. There are two questions from Anonymous. That's a portfolio question. I'll answer that a little bit later. Okay, so both of these questions are on portfolio positioning. I'll answer them a little bit later. Thanks, Denise. Denise is the person in marketing that's helping me with answering the questions and when they're going to come through. Please just keep these on the screen for now. So what else has been happening in the markets, right? This is US disposable income. That's the red line on the left-hand side. What you can see is, ironically, during the crisis, US disposable income has jumped. People suddenly have more money to spend. That is to a large degree as a result of the stimulus and transfer payments. And if you look at the right-hand side, US personal savings rate is also up. Now that's also a combination of the stimulus, but it's also a factor of when people see and experience crises, they tend to save more if they can. And if you're some of the wealthier people in the US, you suddenly can't spend money on travel or expensive restaurants, just like the South Africans. So suddenly you have a high degree of personal income that leads to price pressures in quite a few ways. There's also a bit of an issue around the job market. The US has been experiencing a little bit of a problem in the job market. The blue line is the US unemployment rate. You can see that that has spiked in March, June. It effectively, it spiked to almost above 12, 13, 14%. And since then, it's come down. It's currently sitting on 6%. Now, 6%, while low for South Africa, is actually relatively high for the US. In fact, you can see that 6% job number is the highest number in the last 5 years. But what is interesting is that suddenly, the other thing is that the white line is the US job openings, the available jobs in the US. And that's also at 6% on the right-hand side, and also the highest that it's been for the last 5 years in the US. So there is approximately 6% of people that are unemployed and approximately 6% of the population that could get jobs immediately, but they are not taking them. Now, that's true, and that's occurred for a variety of reasons. Once again, partly as a result of the stimulus. If people are getting paid to stay home and they're only going to be paid a little bit more to take a job, they're going to stay home, right? Firstly. Secondly, to some degree, at least, there's been a bit of a societal shift over the last year, about what people want from a job. People are being asked in the US big cities to come back to the office. And quite a number of them are just saying, actually, no, we'd rather work from home. And if you don't want us to work from home, we'll just quit and find another job. That's making the US job market a little bit different than it has been for a while. And this, let's say, lack of labor force participation or generalized labor strike has led to some pretty significant changes in the US. Suddenly, places like Walmart and McDonald's are offering significant sign-on bonuses. Wages are rising to some degree, and that's also adding to price pressures. If you look at a couple other things on this chart, you'll see a gray line, which is shelter, and the red line, which is services. You'll see there's been spikes there as well. Now, before we go ahead, let's just talk about the other side of the coin. Right? What are the things which we said will push inflation down? Right now, the first thing is population statistics. We know that an economy that has a declining population and an aging population tends to see lower inflation. Right? Lower labor force participation tends, or at least lower labor and lower growth, leads to lower inflation. But also an older population has quite often less tolerance for inflation, and they're quite often more powerful both financially and politically, and they tend to drive or at least push policies that want to keep inflation lower. So we're seeing, and has seen, this is for Japan, an aging population for a while now, and will likely continue to see it. We're also seeing aging and diminishing populations in many European countries. And the US, while they don't have a diminishing population yet, their population is certainly aging. And those things tend to push down inflation. The other thing that has consistently and likely will remain to consistently improve the inflation outlook is technology. We could pull out dozens of graphs of the impact on technology on productivity, price of goods, etc. Whether it's the cost of solar power, the impact that electric cars will have on the price per kilometer driven, the efficiency of airplanes, etc. But there's a number of things on the technological side that also push down supply, push down inflation. Then people are moving, right? And this changes the inflation picture, right? One of the other things that's happened is that people say, well, as I don't want to come to the office, I want to work from home. And you know what? Currently, my home is a tiny little flat in New York. You know what? I'm going to move to Austin, right? Or I'm going to move back to my parents' and grandparents' house or town and buy a big house somewhere in the Midwest, in North Carolina or wherever else. And that means that effectively the cost of rent starts dropping, or at least it is likely to drop at some point in the future. The cost of housing drops, at least in the big cities, right? The participation and the number of people in offices drop. I'm pretty sure that most of you either already or as we are aware that most corporations in South Africa are to a large degree implementing at least partial work from home program and a low occupancy rates. And the South African property companies specifically are going to be affected by this. But the next obvious question is, if you can do your New York job from Austin, could you do it from Cape Town? And it's a lot cheaper living in South Africa than it is living in Austin. Or if you don't want to do it from Cape Town, can you do it from a country in South America? Can you do it from India? Can you imagine the cost of a lot of products and services when they don't have to pay up for American salaries, but they can start outsourcing some of those expensive jobs to Eastern Europe, to India, to areas in China, etc. To some degree, this is if not a precursor, but a repetition of at least some of what we saw with industries, not that, well, the last couple of decades. We saw a lot of the production chain being moved from the US to Middle Eastern, Far Eastern, and Asian countries, dropping the cost of production significantly. Now, if you could partially do that with mid-level managers, professionals, even a couple of executives, suddenly prices drop in other ways as well. So, what are our views around inflation? Local, but primarily global. The first thing is, let's define transitory, because that's the word that seems to be, let's say, at least the word of the year thus far. Now, for the moment, inflation is high, has spiked, is likely to roll over a bit. But if you think about the US, which is expecting a long-term inflation rate of around about 2.5%, at least for the next couple of months, maybe even the next couple of quarters, inflation is likely to print 4% or higher into next year. Now, technically, when it starts dropping off after that to 2.5, etc., it does mean that it's been transitory, but it is at least stretching the general understanding of the word. Now, long term, after that, both the markets and ourselves seem to be pricing in more normalized levels of inflation. If we look at the experience from 2010, if we look at the Japanese experience, it is difficult to argue that inflation long term, driven by a combination of demographics and technological change, is not going to return to a more normalized level, right? But there are risks, which is that expectations and experience is self-reinforcing. If you, as we've seen with South Africa's inflation rates, as inflation kept on dropping, our inflation expectations kept on dropping as well. If inflation stays high enough for long enough, however, the reverse can also happen. And that self-reinforcing cycle can easily start pushing inflation up. For now, we don't think that's likely, but it is still a risk that needs to be monitored. Let's see. Okay, a couple of other fun questions. I'll try and answer them at the end. So just as a quick the reason we answer fun questions and things at the end is CPD points get accumulated and approved for economic and market research rather than for portfolio discussions and marketing. So I'll leave it to the end, primarily for CPD reasons. So what about the local picture? If we think about what inflation in South Africa is likely to look like, or has looked like for a while, we can see that there's been rises in inflation in both Brazil and Russia. But South Africa's picture is still at least somewhat contained. Right? This is from JP Morgan. If we think about what the drivers are of inflation in South Africa, we can see them there, but we kind of know what they are. They're housing, they're transport primarily, and then it's food. Right? So food, transport, and housing. It's one of the big reasons that people talk about saying that CPI differs so significantly for people of different income areas. A couple of years ago, there was a conversation about trying to create differentiated CPI indices for different areas and different ISM bands. So if you think about what that means is food and alcohol, rent, and specifically transport. Now, rent, to some degree at least, and housing costs are somewhat contained for the moment, because with interest rates as low as they are, more people are buying houses, fewer people are renting, rent cost has dropped a little bit, and South Africa has not really experienced the property boom that's kind of going on in the rest of the world at the moment. If you think about food prices tend to vary. They can spike at times. We've not seen them spike significantly. You can see there the year-on-year numbers for food is sitting around about 6%, so it's higher than we would like, but it's not massive, right? The big one is transport being oil. And you can see that that's up at between 10 to 15% the last April, May, June numbers year on year. That's been the one that's driving us. So let's look at transport. Let's look at the oil price. What I have in front of me is the Rand oil price. And you can see that effectively over a 5-year period, we've seen a 13% annualized change in the oil price for South Africa. And quite a bit of that's driven by some of that's driven by the Rand, and some of it's driven just by the price of oil. So what do we think it's going to look like going forward? These numbers come from the First Strand F&B economics teams. And you can see there that we expect oil to kind of go up to 75, maybe 80%. And then as supply starts kicking in and supply growth starts kicking in, we expect it to start dropping and then normalizing closer to 65. The inflationary impact of that over the next couple of years, you can see there in the chart on the right. We expect the inflationary impact for that to be, at least for the next couple of months, to be somewhat below 5%, dropping to 4%, and then rising back to 5%. That being a portion of the change in price of oil, as well then as a portion of the change in price of the currency. So let's look at the currency next. Right, this is the South African Rand versus the US dollar, effectively over the last year, well, effectively since 1995. We can see the Rand is now trading back at 14.65. Earlier the week is trading close to 15. And then about a month or two ago, it was trading at about 13.50. There's a reason that they call the Rand the rattler. Now, if we just zoom in a little bit, we can see what some of those Rand dynamics look like. And once again, you can see effectively up on the screen, there's a horizontal white line in 2016. You're going to struggle to maybe see that, but it shows the average price of the Rand in 2016. And then we've calculated the change in the Rand price from 2016 to this morning, effectively. And it's 0.1% per year. The Rand has not been a significant long-term inflationary factor over the 2015 to 2021 period. Yes, from maybe 2018 to 2019 to 2020, it has been, but over a longer term period from 2016 to 2021, it's not been as much of a factor. Now, we expect the Rand to continue to depreciate over time. And we can see that here, effectively, the the change in rand price over time, and the impact on inflation. Once again, a 4 to 5% impact. Okay, so what do we think inflation is likely going to do over the next 12 to 24 months? We've just seen the peak in our inflation rate. It dropped from above 5% to below 5%. And we expect that to continue dropping. Effectively, spending the rest of the year around about 4.5%, dropping into the low fours towards the start of next year, and then kind of moving towards the midpoint of the band, 4.5 to 5% beyond that. So what is the market taken from that? If you look at the screen right now, what you'll see is the forward rate expectations on the South African rate, so on the yield curve. At the moment, on the 9 to 12-year point, we've got the market is pricing in about 3% worth of rate hikes. And on the 21s, 24s, over a 2-year period, they're pricing in almost 1.75, so 7 rate hikes over a 2-year period. Now, how does that compare with the view internally? We think that we're likely to see a rate hike between now and the end of the year. Excuse me. We think we're likely to see a rate hike between now and the end of the year. We're likely going to see a rate hike towards the first quarter of next year, and then potentially another rate hike towards the end of next year. So we, as a house at FirstRand and as Ashburton, have about 3 rate hikes priced in towards the end of next year. If you look at that and you compare it with effectively what the SARB's QPM model is pricing in, you can see there that the SARB has a model that it uses for interest rate projections, and you can see that they've got a number of rate hikes priced in as well. To put that a little bit in a different perspective, we kind of see pretty close to the same rate towards the end of next year. The SARB model prices in slightly more rate hikes towards the end of the year thereafter, 2022, and then quite a lot more towards the end of 2023. So as a house, we tend to think that there will be significantly fewer rate hikes than is currently being priced in both into the markets and as well as in the SARB's QPM model. This is as a result of a couple of things, but primarily the slow rate of rate hikes globally that's likely to occur, as well as a difficulty in growth in South Africa, are both likely to affect the rate of hikes. So, what are the takeouts from this? Right? How should you think about this in portfolios? Firstly, these 2 rate hikes that we expect is going to increase the 12-month return expectations on things like a money market fund and kind of your enhanced yield portfolios by anywhere from 20 to 40 points. And so if you think about what a money market fund is going to give you, it's currently yielding approximately 4%. It's going to give you 4.2 to 4.4 over the next 12 months, right? If you think about something like a stable income fund, it's going to give you somewhere which is currently yielding about 5.4. It's going to give you between 5.6 to maybe just under 6% for the next 12 months. It's going to be in excess of inflation, where the money market fund is likely going to be almost basically in line with inflation, right? There's a question on the return and variation on diversified income and target return, so I'll answer those now. We expect then the diversified income fund will do approximately 7.5%, give or take 0.5% over the next 12 months. So take it to between 7 to 8%. That's as a result of higher yields, and I'll talk about that now. And for the target return fund, again, about 1% to 1.5% above that. And if we think about and look at what that means, is that those will be the areas where we think you should position yourself if you're looking for returns in excess of inflation. Are these assets that can participate in other areas? The curve is likely to remain steep, so we expect that funds like, for example, the bond fund, the multi-asset income fund, and the multi-asset low equity funds target return, for example, which yes, as the question correctly states, myself and Chris Serum have taken management over. Those funds are likely going to outperform things like an enhanced yield portfolio more significantly than has been the general experience up until the start of 2020. Think about the 5-year period from 2015 to 2020. Your enhanced yield funds, like, for example, Ashburton Stable Income, outperformed inflation quite significantly and performed broadly in line with many of your multi-asset funds. We do not expect that to be the case for the next 12 to 24 months, primarily because while interest rates are likely going to be higher, bond yields are likely going to be even higher still and offer some significant benefits. There's another important point here, which is that the implied cost of diversification is lower. Now, what do I mean by that? If you think about ways people diversify themselves away from risk or in times of crisis, it is generally by buying things like, for example, the US 10-year bond or something like gold, right? If you want to diversify away from the US 10-year, you buy gold. If you want to diversify away from South African risk, you buy something like the US 10-year or developed market bonds. Now, the problem historically has been that these kind of investments yield expectations relative to South African cash yields have been very low. You could get 8% and 8.5% on stable income, and after the currency effect, you could get 4.5%, maybe 5% on an investment in the US 10-year, right? Now you can get 5.5% to 6% on something like stable income, but by investing in offshore debt, you can get 1%, for example, and let's say call it 1% in the US 10-year, and anywhere from 3 to 5% currency depreciation. So you have what is effectively a very nice diversifier away from South African risk, and you're not really giving up significant additional returns. To some extent, the same thing is true with gold, because your expected returns are also quite similar. Now, please take into account these things are not, they are going to be very volatile, right? They are very volatile because of the effects of the currency. But they suddenly, for South African investors, offer at least some form of diversification. And then quickly on the relative attractiveness point, this is why we feel that the multi-asset funds are still likely going to be outperforming things like your cash portfolios. The light turquoise blue line was the 1-year NTD rate. You can see there in 2018, that turquoise blue line was yielding effectively close to 8.5%, whereas the orange line, which is a 10-year bond, was also yielding just a little bit above 8.5%. And up until about the middle of 2019, there was no significant advantage to investing in duration, buying 10-year bonds, over buying cash or investing in cash. That is now no longer the case. You get 4.5%, 5% on your cash investments, but between 8.5% to 9.5% on things like bonds, linkers, preference shares, etc. And then lastly, just to complicate the inflation situation, and before I get to all the questions, is this: what goes up was the lumber price last year. This affected things like housing in the US, which is in a lot of places built from wood. And there were a lot of jokes going around that people should be burning their firewood because it's suddenly a major asset. And you can see that from the start of last year to April this year, lumber went up by 270%, effectively annualized almost 160%. However, this is what quite often happens in response to prices like that. Supply comes back online and the price of lumber dropped 64%. Right now, the same thing is not always possible, right? The same thing doesn't always happen. But for things like lumber, for example, these prices cannot remain at these elevated levels forever, and prices eventually start coming down. Okay, that's the end of the presentation. I'm just going to start answering some of these questions. So the first question is, there are massive pension fund shortfalls around the world caused by, amongst other things, low rates. What lies ahead, considering retirees' pension funds need to take more risk? And what can fixed income managers play in solving this? Okay, so globally, fixed income managers can't do much unless they participate in things like hedge funds, where you can start using leverage, right? Or they're allowed to move out into the risk curve. The general way that those pension fund crises are being solved is by taking more and more risk. Now, that's one of the reasons that my expectation for rates in emerging markets in general is that they're likely going to be at least partially suppressed by the effect of these low global rates. Because as you push pension fund managers and asset managers out of effectively European bonds, and to some degree out of US bonds, and to some degree now even out of high yield bonds. High yield bonds are now offering the lowest real rate in their history. They start moving to places where that is not the case. And one of the places where that is true is emerging market assets. So to answer your question in two parts, in the US, it can be done to some extent with leverage. Firstly, secondly, by taking more risk, and thirdly, by moving into emerging market and other yield-bearing asset classes. So to some degree, at least potentially, fixed income managers globally could allocate at least some assets to emerging market fixed income. How will diversified income fund position itself considering the prospect of higher interest rates ahead? Okay, so higher interest rates affect the cash portion of your portfolio. It also affects to some degree any preference shares you might have, because they price off the prime rate. But as interest rates start rising in the money market and credit portion of the fund, we'll start allocating more assets since then. If you look at diversified income fund, you look at the returns since inception from March 2018, what you'll see is that for the first year and a half up until 2020, there's very, very little variation in the portfolio, because the fund was running at somewhere in the order of 65% credit and money market assets, because of the chart I showed you earlier. But because money market was offering decent returns relative to bonds, we were very heavily invested in money market funds. Not money market funds, money market assets, credit, those kind of things. Floating rate notes. In 2020, however, when the return pictures shifted significantly to favor bonds, we increased our allocation towards both linkers and bonds quite significantly. Right? So right now, the credit and cash money market position in diversified income is closer towards 35%, because we feel there are significant additional returns available within the bond space. Now, because floating rate notes and those kind of things don't generally have volatility, what that means is that fund volatility has increased meaningfully over the last year relative to the first year or two. Now, personally, I think that the role of the asset manager is in asset allocation portfolios is to shift the assets around, sometimes meaningfully, should the return experience change quite a lot. So that is what we've done. And if it starts changing back, we are likely going to change at least back somewhat, right? Should also be noted that while volatility risk has increased a little bit in the portfolio, things like liquidity risk has dropped significantly. Because you hold bonds, and bonds are immediately liquid relative to credit, which quite often is a little bit less liquid, you now have significantly less liquidity risks. For example, because you're holding government bonds, you have less credit risk, right? And things like liquidity risk and credit risks don't show up in a volatility calculation, so they're quite often not taken into account when you only look at a volatility spread. So the next one is, we've taken over the target return fund. So the target return fund, and how does it compare to the other funds in the multi-asset low equity category? Those funds are quite often run by equity heavy teams in South Africa. And that's traditionally what they look like. The biggest fund in that category, as we all know, is the Allan Gray Stable Fund. Allan Gray Stable, as we know, is also primarily or historically been more of an equity house. One of the things when you try and launch and get traction in a new market product is you want to try and see how you can run a competitive product, but maybe in a slightly different way. And our new CIO came up with the idea that given that we have a strong fixed income team and strong fixed income experience and history and credit history, and that category tends to limit your equity exposures to 40% or less, hence it's quite often a majority fixed income fund, that fund should be run more in line with the fixed income process. So we asked from the 1st of December 2019 for myself and Chris Serum. Chris Serum heads up our LDI structuring insurance pension fund desk to run the fund as co-portfolio managers. And effectively what's changed there is we take a much more of a fixed income approach and an income approach to the portfolio. And we think we've done relatively well. It means that the fund is likely to do better when equity markets struggle relative to peers, and maybe likely to underperform when equity markets are doing well. We've seen that play out thus far. It's not been 12 months yet, but the last couple of months, May, June, July have been good months for the fund, whereas January and February and with the first half of March, we slightly underperformed our peers. So we think it's a good fund for clients to use if they are looking to maybe diversify away from a more traditional multi-asset low equity fund, where they can have a slightly different management style, perhaps see a little bit of lower correlation, but still target that CPI plus 3 to CPI plus 4 kind of range. So what are the real yields in South Africa versus the US, and has this translated into any benefits for SA, or are there still too much risks locally? Okay, so real yields in the US is currently about -1 to -1.1% for their inflation-linked bonds. We expect kind of that's pretty close to what the real yields are on the nominal bonds as well. If you factor in about 20 basis points to 0.2% of inflation risk premium. So the real yield on the nominal bond is likely going to be about -0.9 or so, right? In South Africa, if you take an inflation expectation around the midpoint of the band of 4.5, and our 10-year yields are about 9.3, right? So 4.5 to 9 is another 4.5%, 0.3. So our real yields are somewhere between the 4.5 to 5%, depending on your inflation view looking forward. And the question is, has that been a benefit for us? Now, to define that us, you got to define the question, you kind of have to define us. It's been a significant boon for South African investors, right? You can invest in our local debt market and get returns that are 4 or 5% in real terms, right? The current yield on the All-B is somewhere in the range of 9.5%, which is 5% above inflation, right? So it is a benefit to South African investors being able to invest in another asset class that's not equity, that is liquid, that gives you 5% above inflation. The secondary question, and what I think the question was maybe more meant at, was, has it been of a benefit to the South African fiscus and so forth, and have we seen a lot of international participation? The answer to that question is no, not as much. We've seen some inflows, but they've not been as big as the outflows that we've seen. I think it's important to think back to the fact that last year we were removed from a number of investment grade investment indices, which just means that there are now a number of portfolios and ETFs that can no longer invest in South Africa. And while there are still a number of active managers right, that could invest in South Africa and that still can invest in South Africa, those were always there. So effectively what we lost was the passive and some of the benchmarked funds that were trying to track or outperform your investment grade sovereigns. Now that we no longer have that participation and that passive debt flow, two things have happened. Our international ownership numbers have started to have dropped off structurally. They've increased a bit and decreased a little bit, but over the they've seen increases and decreases over the last 6 to 12 months, but it's structurally lower than when we ended 2019. That's the one thing. The second thing is because a larger share of your foreign participation and ownership is now active managers relative to passive investors, it means that you now are being bought and sold more actively and more frequently, and those flows on a smaller ownership share has a larger effect on your local bond markets, right? As a result, volatility on our markets have picked up a little bit as well, right? So that's the realization for now, is that we've not really benefited as a country from it. But from a local investor and pension fund standpoint, people have certainly benefited. And then the question on just the variation. Unfortunately, I don't know the precise standard deviation for diversified income and for target return. We've got a minute or two left. Are there any other questions from the floor, from anyone else? Okay. Thank you very much, everyone, for attending this morning. I hope it was useful. We will be doing this every 3 months going forward. This one was from a question from a couple of advisors and IFAs like yourselves who wanted a presentation on rates and inflation view going forward. If there's any other questions that are fixed income or macro or process related around anything about that, or hedging, portfolio hedging, asset allocation processes, or anything else, please send through those questions and we'll focus a session on what you might be interested rather than on what I might be interested. Thanks again for attending, and I hope everyone has a good Friday tomorrow and a good weekend. Bye-bye.